This is episode 6 of the Stock Market Stories podcast. Today's guest is Fernando Chague, a financial academic based in Brazil who studies behavioral biases, short selling, and the behavior of retail traders. In 2019, Fernando and his two colleagues, Rodrigo de Loso and Bruno Giovanetti, published a study called Day Trading for a Living. It argues that consistent day trading profits are near impossible. Needless to say, this created a lot of controversy in the trading community and the wider finance world. Actually, in episode 1 of this podcast with Peter too, a prop trader, I asked him about this study, and Peter basically agreed with every finding of the study, believe it or not. Even given the fact that Peter is a longtime successful trader, both retail and prop, and he knows countless successful trader friends. And for that reason, I invited Fernando on the show to talk about the study and some of his other research, which is really interesting. So beyond this day trading study, which was featured in Bloomberg and the Financial Times, we talk about other cool research Fernando is doing, like the supply-demand dynamics in Brazilian securities lending markets. So enjoy this excellent episode with Fernando Chague. We talked like 2 years ago about scheduling a podcast to talk about this day trading for a living study. It got a lot of media attention. It was in Bloomberg. It was mentioned in FT, CNN, Brazil, whatnot. And, in trader circles, it became a huge subject of debate. So why don't you start by giving us an overview of this study and what inspired you to pick this topic?
Okay, great, Bet. So here in Brazil, we are experiencing an increase in interest from retail investors in the stock market. So, and I guess this is similar elsewhere. In part because new technology that makes it easier for retail investors to trade in the stock market. So that's a very large part of the reason why retail investors are trading in Brazilian stock markets and elsewhere. We also have some other institutional details in Brazil that also help that trend. So that's one thing. So when I started looking into this, there was huge interest from retail investors in day trading. I talk regularly with the Brazilian SEC, which is the CVM, and they were interested in that phenomenon. So why are retail investors diving into this day trading? And obviously they have an idea that they were losing lots of money. So they were interested in learning more about that. So we talked, and then I was able to get this data set, which is anonymized data set, but allows us to follow all day traders, the Brazilian day traders from 2012 to 2017.
I just want to cut in there. I'm sorry.
Yeah, sure.
That data set is directly from your financial regulator, CVM, right?
That's right, yes.
So it's high quality, the highest quality data you can probably get.
Yes, so that's one thing about the study is that we use high quality data and we look at all investors. So this is not just like one brokerage set of investors or a partial view of the market. It's the entire Brazilian market that we're looking at. So we're looking basically at all investors doing all types of trading strategies. So it's not like a subsample of the Brazilian universe. So that's one thing. So it's a very high quality data, and we look at everybody, all our retail investors. So we started, so you asked about how we started. So there was this interest, and we had this data set. And the thing that we realized at the very beginning is that, as I mentioned, people were talking about day trading in the media, in Twitter and YouTube. There were course providers. There was a news article talking about that. And in all that material, we couldn't find any piece of, detailed information about the actual odds of day trading. And in particular, day trade for a living, which is, when you try to do day trade for a long periods of time. So we couldn't find high quality data with the odds of that. So that's why we started, me and my co-authors, and Bruno and Rodrigo, we decided, okay, maybe we should convey that information using high quality data in a very simple way. So people are informed about the actual odds of doing day trade, and then they decide if they want to do that or not. But we decided to put in a very simple way important information so that investors they decide using more information, which I think is particularly important in this type of trading strategy. So that's how it started, and that's how this study was conducted.
Yeah, the study's direct and to the point too. So if you're not an academic and don't really like reading these long graphs that maybe you don't understand, this study is, I think, about 10 or 12 pages, and it's direct to the point. They speak in direct language. There's only, I think, 3 charts. And so, which is great because it makes it easy for someone that might want to spend a year or two day trading. They could read this and say, oh, maybe it is or it isn't a good idea. It's just more information. So why don't you tell us a little bit about the findings of this study? And did you go in thinking, with a certain opinion of what you'd find? And how did you come away from it after publishing the study?
Okay, so the focus of the study is to see how beginners, right? So new day traders, how they do and whether they learn, and look at the numbers. So my prior was that I wouldn't find it wasn't. Their performance wouldn't be good because they're competing against experienced day traders and also professional investors, institutions, and high frequency traders. So my prior was, okay, they won't do very well. But even with that negative prior, I was pretty surprised with the finding because the performance is even worse than I expected. So let me give you a couple of numbers. So we look at new day traders. So day traders that started to day trade between 2013 and 2015. So that was one. That's one set. So that's the main goal. And then from these investors, I have the number here. Let me see if I can find it. There were about 20,000 Brazilian investors doing day trade. And by the way, in this first study, we focus on futures because that's where the majority of Brazilian day traders trade. So they like the liquidity and the volatility that this type of financial instruments offer. So we focus on the futures market. We have contracts that very similar to the Standard & Poor's mini contracts, and we also have exchange rate contracts that follow the dollar. So these are the 2 largest by far instruments that day traders use.
These are highly liquid too.
Highly, very, very, very. So there are about 20,000 retail investors that started to day trade from 2013 to 2015. And then we look at, out of those 20,000, how many of them continue to day trade for a long period of time? So that was the idea. We wanted to focus on day trade for a living. So we want to look at investors that insisted in day trading. And then we find that only about 8% of these 20,000 investors, they insisted in day trading. That is, they did that for more than 300 days. So it was about a year and 50 and 2 months of trading. So only 8% of these 20,000, they continued doing day trade. So the number was about 1,500 investors.
And if I can just cut in really quick.
Yeah, sure.
With regard to that number, the 8% that persisted for X amount of days, does that mean they're making a certain amount of trades per day or week?
They can do just number of days that they open the home broker and they did at least one day trade.
Gotcha. Okay.
For 300 days, they sit in front of their computer or their cellular phones and they did a day trade for 300 days, trading days. These are investors that are insisting, right? They're persisting and they are probably trying to live off day trading. So that was, So you can see that already that from the 20,000 that it started, most of them either decided to quit, realize that this is not, a good deal, or whatever. I mean, just 8% persisted for more than 300 days.
Yeah.
Okay. And then we look at this. Okay, so maybe these guys that are insisted for more than 300 days, they are insisting because they are making money. So, okay, it makes sense, right? I mean, whatever you look that people are insisting is because they're doing better than otherwise, right? But otherwise, why would they insist? Okay. And then we look at this 1,500 investors. Okay, let's see if they profit and if they profit by how much. And then the surprise was that most of them were also losing money. So out of these 1,500 investors, about about 7 of them, only 1%. That was, I'm sorry, I don't have the number here. It's about 1%. They earn more than the Brazilian minimum wage. So most of them, they lose money. And those that make a little money, they just make barely above the Brazilian minimum wage. So the bottom line is most of them, they don't persist. Those who persist, they don't make enough money, that would maybe compensate for the high risk of not making money. So maybe these guys are making millions. Okay, so maybe it's worth to try,
Yeah, right.
But this was not the case. So that was basically the main message of this study. And as you can imagine, it repercussed the repercussion was very large here in Brazil and also elsewhere because the numbers are really, really, really bad.
Yeah, and what's crazy is of the few that had, what you can, I guess, call consistent profitability, their volatility, daily volatility, was insane to the point where even if these guys, could consistently profit, you punch that out into a statement, put it in an Excel sheet, and try to join a proprietary trading firm, they're not going to take you. You're going to blow them up with those numbers. Honestly, reading it was shocking to me, because in America, there's, it's probably equally hard to become a consistent day trader here. It's, some of the most competitive markets in the world. But I personally know people that make a living from it. And it's like, wow, are they achieving it against these odds, or is the market structure different?
Yeah, I mean, as I mentioned, 1% of this pool of investors, they make some money, but they don't make enough, So it's about 1% that make, some money.
Yeah.
Those that make, and very few make, some reasonable money, but it's just, it's not the number that I would expect, going into this study. And I think most of investors are trying to do day trade, for a living. They probably don't expect to be, first of all, such a low probability of making some money, and given that you make money, you're not making, tons of money. So these two things were kind of surprising for me, and I think for most of investors that try to do that after they read the paper.
Yeah, and what's another thing that kind of I had a different expectation of, different experience and prior knowledge was the idea that these traders in your database did not learn through experience. So the more they traded, the more money they lost, and you compared it to roulette. Like the more times you play roulette, the more likely you're going to lose.
Yeah, we have a very nice chart in the one of the few charts. I think it's just one or two, as you mentioned, is a very short note, and you can see that the fraction of day trade is positive profit, the decline as you increase the number of trading days, and this pattern you see when you're playing by chance. I mean, otherwise you would improve your fraction of profit as the number of days increase. Here it decreases, so the pattern is more it resembles that of a game by chance. So
it looks like the expected value over a number of slot machine spins or something. Like you increase the number and you arrive at that expected value.
Yeah, which is negative. So I mean, some day traders, they profit, of course. I mean, you can day trade for a couple of days and maybe you have a couple of inside informations or good calls, but eventually, I mean, over time, I mean, you're really lucky at the beginning or you had some information, but then over time, it's very difficult, to consistently beat the market. And especially for retail investors trading from home, playing with their computer very far from, where the prices are being set. So that's what happens. Yeah, it's and the graph is very clear. The numbers are very clear.
Yeah. So, we've kind of covered everything from this study. Like we both mentioned, it's short and sweet. Everybody should read it. I'm sure some people listening to this are full-time day traders that make a great living and actually have a good Sharpe ratio and everything. I know they exist. I've talked to them, but it's definitely worth reading. And on that note, the first guest of this podcast was a trader called Peter Tu, proprietary trader, really skilled, made tons of money over his career. I asked him about this study, and he completely agreed with your outcome. He's like, yeah, totally. It's, the vast majority of people lose money. And I think the only caveat he had is that perhaps the risk-adjusted returns could potentially be really good in day trading if you have like some special strategies, special sauce or something.
Yeah, I mean, I'm not saying that there's zero investors that make money. I mean, we are looking at this study, we're looking at investors that decided to start doing day trade. So the focus of the study is on the beginners, right?
Yes.
Almost all begin, not all, but 99%, they don't make a decent living out of that. So that's the relevant piece of information. If you want to start doing that, just have in mind that it's pretty much almost impossible for you to make a living. And my hunch is that the probability, and the difficulty is getting, even worse because of, the presence of high frequency traders and that weren't so present in the past. So that's one message. So yes, there are professional day traders that profit. There are high frequency day traders that profit. I mean, day trading is a zero-sum game. So if someone is losing, someone is making money, of course.
Right.
So there are those investors. Who are those? Institutions, high frequency traders that invest millions and millions of dollars in technology. They invest millions in, collocation. They have their algorithm in place very close to where prices are being set. So these are the investors that retail investors are trading against. These are very uneven. And so that's, I hope that this is the message that those retail investors read in this paper, they get, because they are playing an uneven game. They are, wasting their money and also time, because they could have been working on something more productive, and they're not. So they have to have that in mind, and before they start, doing that. But again, this is just information. And everybody should, read if they want or not, and then they decide, the best based on the best information they can get from.
Right. So moving on from day trading for a living, which again, everybody should go check out. There will be a link in the show notes. I want to shift more to, what you're working on nowadays and what you're interested in, because, you publish a lot of great research, and, I'd love to hear more about it.
Oh, sure. Great. So I have a couple more academic papers. So my research, I'm mainly interested in two sets of two strands of the literature. So one is about behavioral biases. I'm interested in behavioral biases literature, and the other I have also a research agenda on the limits to arbitrage, and more specifically those that arise at short selling. So if you have a negative price about a particular firm, you have to sell the stock, right? If you own the stock, you can sell the stock that you own. But if you don't own the stock, you have to short sell, right? So this is how hedge funds and these very directional investors they do negative bets, so they short sell. So for you to do that, you have to go to the equity lending market and loan stock. And curiously is that this very important piece of the market, the equity lending market, is an over-the-counter market, which is, kind of surprising, because short selling is such an important operation, such an important strategy for price efficiency. But at the same time, it has to rely on an over-the-counter market that for some stocks, it doesn't work very well. So I have a couple of research on that limits to arbitrage that arise because of this opacity in the equity lending market. And I mentioned that I have also research on behavioral biases, which is also, and here more specifically related to retail investors, right? Which are the group of investors that are more prone to these biases.
Right. So you touched on how the lending market for equity short selling is over the counter, right? And it's the same thing here in America.
Yes.
And what, with an OTC stock, let's say on the OTC pink sheets or something, as far as I know, you could, you put an offer or a bid out there, and there's multiple market makers that can interact with you. Whereas if I have a brokerage account with Charles Schwab or TD Ameritrade, and I want to borrow a stock, as far as I know, I'm only dealing with their lending desk, right? So
yes.
If you can give us a little insight, because there's very little information because I've tried to look into this. How does that work? And as there's like a bid and an offer for borrows, is there not?
Yeah, so the way it works is the following. So you are a short seller, and you call your broker, and you ask the broker, "Hey, I need X amount of shares because I'm selling short these stocks. Can you find them for me?" Some stocks are very easy, so that won't be a problem. But some stocks, the broker might have a hard time finding them. So the broker can find these stocks on their inventory. So there are clients that agree to, beforehand to lend those stocks, or the broker may, call other brokers and go after, other lenders outside their own inventory to find those stocks. Usually it's the short seller is the aggressive part, and the lenders usually they are kind of passive. They just agree that to lend the stocks beforehand. So the lenders they are not so active like would be in other perhaps of the OTC markets. But this is in a nutshell how it works.
Okay.
Yeah.
Okay.
So basically what happens is that on the same day for the same stock, on the same amount of shares, some borrowers, that is some short sellers, they pay, very different loan fees. So the cost to borrow the stocks is very different for the same stock on the same day, on the same amount. That's because of the opacity of the market. So however, the first paper, 2017, that we look exactly into that, and we find that some investors that are better connected in that market, that is, they have access to better brokers who in turn have access to the better lenders. These investors, they end up paying much lower loan fees. So the cost of short selling is much lower for these investors than those investors that are not connected to good brokers. So that's one of the key findings that we have in that paper. The second finding that might be interesting is that we find that investors that are connected to at least two brokers, they are able to bargain much better loan fees than investors that have access to just one broker. So one recommendation would be, have at least two brokerage accounts, because by doing that, you'll be able to bargain better loan fees when you're trying to find, stocks to short sell. So that's another conclusion of that paper.
And if I'm not mistaken, in your 2019 paper about short selling, you found that the people that got the lowest cost on their borrows also tended to be excellent short sellers. They had alpha in their short picks. Is that correct?
Yes, nice. So the 2019 paper, we look at short selling skill. There's this huge debate about whether there is skill in the market or not, or whether funds are able to achieve alpha consistently. The problem with that type of evidence is that usually you need very long data sets to reliably find that these alphas that funds are able to get are statistically significant or not. So one thing that we do in that paper is that, okay, let's look not at the entire portfolio performance of the funds, but let's look at this just the short selling decisions of each of these investors. Because these are very short-lived decisions. On average, a short selling lasts about 2 weeks. So these are very directional bets. And we were able to look at thousands of these directional short-lived bets. And then we're able to statistically infer whether a particular investor is statistically good at short selling. And then what we do in this paper is we look, okay, so we have a pre-sample. We divide the sample in two parts. And okay, so this subgroup of investors that are able to profit consistently, are these investors that profit consistently in this pre-sample also going to perform consistently out of sample? And yes, we do find evidence that there is persistence in skill regarding specifically short selling, as one would expect. But again, this type of evidence is kind of hard to find, because when you're looking at portfolio alpha, you need a very large data set to reliably conclude that these investors, these funds are skilled out of sample, right? Or persistently skilled. So that's, I guess, the key conclusion of the 2019 paper. We look at other things that, okay, so let's look at these skilled short sellers and what type of strategy are they following? And because we're interested in the skilled short sellers, not on the general short sellers. Now, the evidence is that on average, short selling is informative about future returns, right? There's this very large literature showing that. But what we do in this paper again is, okay, so let's separate the informed short selling for uninformed short selling. And then we get, of course, much more precise indicators about future performance. And also, we are able to look at what these guys are doing. And we find that, for instance, that these short sellers, they are momentum investors. So they tend to, short sell when the stock is already falling. So this is one interesting piece of evidence. And we have a number of other results in that 2019 paper. Again, this is a much larger paper than a short note because it's an academic paper and we have lots of stuff. There are interesting stuff that might interest practitioners. Again, this is because we're able to. This is a very interesting data set because we're able to track all short sellers over time. So we are not talking about retail investors here. Of course, we look at retail short seller, but these are just a small fraction of the short selling universe that we have in Brazil. So most of the short sellers that I'm talking about are institutions that we look at in that paper. Yeah.
Right. Excellent. So I was going to follow up and ask, what factors are the skilled short sellers exploiting? You mentioned momentum. Is there anything else you found specifically?
I think they also have some evidence of value investing, I guess. But the thing that struck me the most was the momentum one, because the general consensus on the academic literature, when you look at the aggregate short selling activity, is that short sellers, they correct overpricing, so they short sell after price increases. The thing is that when you open that short selling and volume, the aggregate short selling, and you separate into skilled and unskilled short sellers, what you find is that the skilled ones, the guys that you want to follow, they actually are momentum. So they short sell after price falls as opposed to price increases, which is the evidence that you have when you look at aggregate short selling. And and also we also have a recent paper, a couple of recent papers. The one that just got published this year is also an interesting paper, if you don't mind.
Yeah, absolutely.
Sure, because I think it's one thing that regulators should have in mind elsewhere. So here in Brazil, we have a loan fee benchmark. So the Brazilian Stock Exchange makes public the average loan fee for each stock to the general public. So the idea is that to reduce opacity. So you are a short seller, you want to short sell, you don't know the cost of that, but you have an idea because there is a benchmark, an average price of the recent past loan fees charged by the market. And this is one nice feature of the Brazilian stock market that is absent, for instance, in the US. So an investor in the US, they don't know what the average loan fee is, even with delay. So they have to rely, on the information that they're able to get inside their brokerage house, or they can get some data providers that provide some partial information about the market. So one thing about Brazilian is that the stock exchange announces the average loan fee of the entire, across all deals closed in that particular stock. So what we do in this recent paper is that we look at a change in the way the Brazilian Stock Exchange compute the loan fee. So before, they used to provide information about the average 15 days loan fee, and then at some point in time, they decided to change that to 3 days. And we look at that the impact of that improved information on the equity lending market, because after the change, short sellers were able to predict much better the loan fees they would pay after the change, the averages, the number of days they used to compute the averages. And we find that this positive shock in price transparency, right, the reduction in opacity, improved the equity lending markets and also improved price efficiency. So that's a very nice result that, because it's not very difficult for you, to provide that type of information. It's something that stock exchange, they could do that.
Yeah.
and we show that it improves the quality of the market. So that's one thing for regulators to have in mind, that maybe why not help short sellers and provide the average lending fee that are being charged in the market as a relevant piece of information for short sellers.
Yeah, that's really interesting. So you found that loan fees must have gone down across the board once they went from 15 to 3?
Yes. So loan fees go down because now short sellers, they have more information, so they're able to bargain better fees. Lenders, they lose monopoly power because, if you have opacity, lenders are able, to capture part of, of this. They are able to discriminate better prices. But if prices are transparent and you have a benchmark, short sellers benefit. On the other hand, lenders, they continue lending because they have the stock. So every piece of dollar that they are able to get, they will accept. So overall, the end result, it was positive. Yeah.
Yeah, that's very interesting. So, moving on towards wrapping up here, I would love to hear about what you're working on, like what you might come out with in the future, and maybe just give us some background about you so interested people can follow you and look at your future research.
Sure. Just to mention, I have a recent working paper about an interesting paper about, at least I think that is interesting, about behavioral biases. So we have a very interesting thing here in Brazil is that if you sell less than 20,000 reais, which is about $8,000 per month, you don't have to pay capital gains taxes. But if you sell $1 above that threshold, you have to pay capital gains taxes over the entire amount. So this thing about Brazilian, capital gains tax, that applies only to retail investors, not to institutional investors. And so we use that threshold to find those investors that weren't aware and just sold in amount just below the threshold. So just above. So they end up paying more taxes than they should because they were inattentive to this particular law. This law is very, everybody knows about this law. So this is evidence that investors were inattentive. They weren't thinking straight, when they decided to sell. Just sell, forget about that. And then what we find is that those investors that forgot about that law, out of sample, were also more prone to several behavioral biases. So we're connecting that kind of inattention for a particular tax-related law, and that explains a lot about the other behavioral biases that investors have. So we look at disposition effect, under diversification, a preference for lottery stocks, salient stocks. So in all of those dimensions, the investors also are more prone to choose, to fall in those behavioral biases. So I found that it's a very interesting piece of finding evidence that, something that is in principle unrelated to anything, right? I mean, taxes, it has nothing to do with trading ability or skill, but it turns out that it explains a lot about, the probability of the investor falling into behavioral biases. And the conclusion is that, you have to, the idea of, Kahneman system 1 and system 2 is that you have to, take a step back, think carefully when you're making a decision. And that also applies to, when you're paying taxes and also when you're choosing a particular stock that might be, salient and that will not be a good investment. So that's an example of a working paper.
Yeah, it's a really neat way to isolate investors that are likely to make a bunch of other mistakes. That's really clever.
Yeah. So that's an interesting working paper we finished and it's about to be published, I hope. Yeah.
Right on. Okay.
So, yeah, good. So, just if you allow, just one piece of very, very fresh research that we are very excited about because it has to do with the equity lending markets. Is we are looking at networks in the equity lending market and we are trying to see whether information gets leaked through the equity lending desk. So you are a short seller and you want to short sell, and you do that, you short sell, and you call your broker, hey, I want this amount of shares. The equity lending desk automatically gets aware of that because this is an OTC market, it's not an anonymous market. So the brokerage house and the equity lending desk knows who is calling for those, for those shares to borrow. And so we have a very recent paper that we look at information dissemination through equity lending desks. And we do find evidence that brokerage houses, they kind of leak this information to other clients. This is a very preliminary work. We have a recent version soon in my webpage. But yeah, that's another thing that I'm excited about these days.
Yeah, this is why I have you on. You study really, really interesting topics. That sounds really cool, and I do wonder if a Brazilian trader could kind of look at lending rates and maybe see that there's a catalyst incoming or something that brings to mind some ideas from a trader perspective. So why don't we wrap up by you just telling us a bit about your background and where we can find you if you have a website or something like that.
Sure. Yes. Okay. So I'm currently at Sao Paulo School of Economics at FGV. I'm a professor here, associate professor of economics and finance. And I've been here since 2017. Before that, I was at University of Sao Paulo. I did my PhD in the US, University of North Carolina, Chapel Hill. And I finished there in 2012. And I have a website. So, you can, I guess, Google my name, Fernando Chague. I also have a Twitter account that sometimes I post some of these, recent findings and recent updates on papers. So I could post information there as well.
Great. Yeah, I'll put both of those notes in the show notes. I'm sure people are going to want to follow your Twitter for sure, see what you think about certain things.
Great.
So thank you so much, Fernando, for coming on. Your research is great. I love reading it. And in the future, when you come out with more interesting papers, I'd be happy to have you back on and talk them through.
Sure. Great. Thank you very much, Pat.
Thank you so much, Fernando. You have a great rest of your day.
You too. Bye.
All right. Bye-bye. Thanks a lot for listening to the Stock Market Stories podcast. You could really help me out by leaving a 5-star review on Apple Podcasts or Spotify. And as always, you can find episodes on stockmarketstories.net. You can look us up on Apple Podcasts, Spotify. We're on all the podcast apps. If you want a link to your specific app, just go to stockmarketstories.net, scroll to the bottom. There's links for all the apps there. If you're a new listener, you should know a little bit about what this show's about. So the idea is pretty simple. It's interviewing interesting traders and investors and other people in finance. But I really want to emphasize people that have slightly out of the mainstream strategies or people that do things that there aren't books and articles written about, right? So if you want to help me out and make the podcast a little better, if you have any guest ideas, please reach out to me. You can find me on Twitter at StockPodcast, or you can go to stockmarketstories.net/contact and send me an email. But until next time, thanks a lot for listening.